In an economy, the interest rates charged on funds have an effect on stock and foreign exchange currency markets. When the central bank changes key interest rates, the markets go up and down. These are based on anticipations of economic activity. What is the reasoning behind this? What interest rates are we talking about? How does it affect your investments? Welcome to Investorzilla, your destination for financial education, investment analysis, and economic indicators. Subscribe to this channel for more such videos. Interest rates used for lending are a key driver to control the supply of money in an economy. Every country or a region has a benchmark interest rate which is taken as a reference. All other lending rates, such as mortgage, credit card and bond interest rates, are arrived at by adding a margin percentage on top of the benchmark interest rates. What are these interest rates? Each central bank uses their own benchmark rate. For the United States Federal Reserve and the European Central Bank, the benchmark rate is the rate at which banks in their respective regions lend to each other. In the United States, it is called as the federal funds rate or the discount rate, whereas in Europe it is called as Euro Overnight Index Average. For some central banks like the Reserve Bank of India, the benchmark interest rate is the rate at which the Reserve Bank lends to the banks. In India, it is called as the repo rate. What is the effect of interest rates on the stock prices? When a central bank lowers interest rates, banks are in a position to offer cheaper loans to corporates. Cheap loans means more investment by corporates. This leads to more production of goods and more profits. The anticipation of the improved profits arising from the increased investment drives the stock price of these corporates higher. The reverse happens when the central bank raises interest rates. Loans become expensive. The corporates put on hold their investment plans. This leads to less production and possibly lesser profits. The stock prices of these corporates drop in anticipation of lesser profits. What is the effect of interest rates on bond prices? When a central bank lowers interest rates, the bonds tend to be less attractive due to reduced coupon payments. So investors invest in the equity or stock market. This drives up the stock prices and drives down the bond prices. Companies which depend on corporate bonds would find less takers to invest in their bonds. They would have to access marginally higher cost funds through bank loans. These companies could, however, see a drop in their stock prices. The reverse happens when the central bank raises interest rates. Bonds offer higher coupon rates. More investments flow into bonds due to their risk-free investment nature, as well as anticipating lower profits from corporate stocks. This pushes up the bond prices and drives down the stock prices. The demand for bonds also goes up in times of economic uncertainty, when investors would invest in safe government securities rather than the stock market. What is the effect of interest rates on employment? When a central bank lowers interest rates, due to more investment, there are more employment opportunities. Some companies may announce hiring plans. This puts more money in the hands of consumers to make more purchases. This results in more profit for corporates. The anticipation of the improved profits drives the stock price of these corporates higher. The reverse happens when the central bank raises interest rates. Corporates might delay their investment plans. Hiring freezes. Job cuts result in lower production and thus lower profits. This anticipation drives down the stock prices. What is the effect of interest rates on the currency? When a central bank lowers interest rates, holding investments in the currency with lower interest rates becomes less attractive for investors relative to currency that pays a higher interest rate. This typically results in less demand for the currency and often causes the currency to depreciate. When currency depreciates, the exports become cheaper. You earn more for the exports. Stock prices of companies engaged in export of goods rises. The imports become expensive as you now pay more for the imports. Stock prices go down for companies that import raw materials or goods. When a central bank raises interest rates, more investments flow in from other countries with investors looking to take advantage of higher interest rates. This results in currency appreciation. Exports become expensive. Due to currency appreciation against other currency, the goods of the country will now be more expensive in other countries. This will lead to lower value for exports and thus lower profits for exporters. This decreases the stock price of companies who export more. Imports become cheaper as the currency can buy more. This increases stock prices of companies who depend on imports as their profits increase. What is the effect of interest rates on GDP and inflation? One of the key decisions for reducing interest rates in the recent past has been to stimulate the economic activity and increase the GDP output. Lowering of interest rates will increase spending, as consumers tend to invest in real estate, durables and auto. The stock prices of these companies could be expected to go up provided they do not have expensive raw materials as imports. This will also result in an increase in the price of commodities, leading to higher inflation. This increases the GDP. While moderate inflation is required for economic growth, higher inflation tends to affect the economic growth as well. Most central banks have a target inflation range which they would like to maintain. For example, the Fed maintains a target inflation of 2–3% every year. Higher interest rates will reduce spending as consumers tend to save more to take advantage of higher savings rate as well as postpone decisions related to big investments which require loans. This anticipation drives down the stock prices of companies engaged in consumer durables, auto and housing. This leads to lower inflation and decreases the GDP. What is the effect of interest rates on commodities like crude oil and gold? Commodities are affected depending on whether they are imported or exported in a nation's economy. Commodities like crude oil form a higher percentage of imports for most economies. Crude imports for a nation will cost more if the lowering of interest rates leads to currency depreciation of a nation's currency. Oil companies would be affected by the effect of a depreciated currency due to lower interest rates. Stock prices of companies which depend on crude oil imports will be affected by depreciation in a nation's currency, leading to expensive crude imports. When interest rates are raised, the currency appreciates. If a nation imports more crude oil, it would result in cheaper imports and cheaper petroleum products. This drives up the stocks of the companies dependent on this commodity. Commodities like gold are not directly affected by interest rates. When interest rates are reduced sometimes to zero or even negative, it erodes the investor confidence in the economy. This pulls money out of the stock or bond markets as investors turn to gold as a safe investment, driving up gold prices. Gold prices tend to go down when the interest rates are raised or once the economy improves as investors turn to stocks and bonds. This drives up the stock prices. If you like this video, hit the thumbs up button and subscribe to this channel for more such videos.